Greetings, everybody. It's Jeff Scott. It is Saturday going into near Sunday, which will be the 19th of 2020. Back home, so hopefully the audio will be better. Monday is a holiday for Martin Luther King Day, so the next day in the market is Tuesday. And just a heads up, Tuesday after hours, Netflix earnings. I entitled today, Melting Up. And then in some of the words, you know it from the song called The Gambler by Kenny Rogers. And I just remember Ian Woodward singing at our meetings, know when to hold them and know when to fold them. And this may be close to a decision point, especially on the fold them. As always, this is for education purposes only. I'm a doctor, not a broker. I'm independent. I pay for the tools that I use. And trading involves risk. You alone are solely responsible for any investment decisions you make. I often talk about options. Options are considered extremely risky, and you are responsible for any option trading as well. And I highly recommend you go to the Options Industry Council and read their disclaimers. And I am a huge fan of options. And I think the first part of being an options trader is education. So first, be your own guru. Key influences on my style. Here's Ian. He learned CanSlim early on. O'Neill is the developer of CanSlim. Morales and Katcher wrote some great books that I highly recommend. George Lee, my trading buddy from Western Canada. Van Tharp, the king of position size and money management. Cigar from Zero Profits, got some great indicators, one of which helped me find my Tesla short this week. And then John Person, who has an educator, mentor, friend, developer of indicators, author. He really helped me go from a list of stocks to how to trade them and make money. I have the comment about be your own guru on purpose. Often people tell me this looks easy when I do it. It can't be that easy. It's not easy. I spent a lot of time and money getting educated, but it's easier than you think, and it doesn't happen without learning. And for me, that meant going to seminars, reading books, taking my lumps, blowing up accounts, and developing a style that works for me. I own a lot of software. I need TradeStation and Thinkorswim and some of the indicator sets that I use, especially John Person's and Cigars. I use HGSI for most of my analytics to find stocks that I want to trade. EdgeRater is a great tool for automating processes. And then I supplement with seasonality and other tools. Here is the website for HGSI. Highly recommended. It comes with a free 30-day trial. Under investing strategies, you'll find a number of movies. Yes, you'll download it and you'll see a bar. You'll probably get frustrated. Before you click it and shut it down, I highly recommend you reach out to me at hgsidoc@gmail.com, and I'll share with you the vocabulary and how I use the tools. Stock patterns are cyclical. Every time it feels like we roll over, as it started to do at some point in late December, we make a rally up and go on to new highs. Well, we're at that point right now. The question is, are we closer to a new buy signal and a new big run, or are we closer to a sell signal? I'm going to put my bet is that we're closer to a sell signal, but that could be a short-term correction of 2 to 5% and then back to new highs. I'm not looking for a major market dump, especially since there's no evidence of a imminent recession. So, since I think that we are not going to crash, I've been relatively offensive in this market still. I have raised cash. You'll see a higher number there. I want to show you my portfolio. I've rolled my calls up and out, which means I've taken cash off the table. I've sold premium against many of my positions. I bought some puts, but I'm still net long. Here is the market finish on Friday. Green is bullish, red is bearish, and mixed day, but certainly not a weak day. Major markets tell the story, and first thing is notice the little white balloons on the last bar on all the major indexes. That means we had 52-week highs set during the week on the major indexes. So here we can see upper left is the E-minis, middle NASDAQ futures, upper right is the Dow futures, lower left is the Russell ETF, the VIX futures, and then in the lower right, the dollar. So what do I see? Beautiful runs, clearly in a probably terminal phase as the ascent has started to go more vertical, but these can go on for quite some time, despite how I talk about overbought. But I think you've got to be a little bit cautious here. You did see a red candle high and a reversal on the Russell on Friday. Is that one and done, or is that something we're going to see more of? The VIX is certainly down in the land of complacency, and the dollar is struggling at the 200 weekly average. If I switch us to the monthly charts, I mean, the point here is you'll just see how incredible some of these, the weekly charts, how incredible these moves have been. And this a little bit bigger. Lower left, upper rights across the board. And the only pertinent thing here is we set new weekly highs on the top three, is we still haven't taken out the 2018 highs on the Russell. And you can see the VIX is about as low as it likes to go, and the dollar is going sideways. Put that back to, so I don't forget. Back to the PowerPoint. The PowerPoint was made today, so all the slides I show you of market data are as of this morning and include the close on Friday. Rates on both the 10-year and the 30-year, it's hard to see. They actually ticked up a couple of ticks this week. And while that happened, you can kind of see here that the spread between the 2 and the 10 years actually ticked down. Still nowhere close to the inversion line. AD lines, and this is something that's music for the bulls, on both the small caps and the large caps, set new highs again. And notice how even the Russell 2000 is trying to catch up with its prior highs. The Russell 1000, the large cap index, is at all-time highs. If I look at the NYSE, you can see it turned up. All these, as you can see listed here, are the major market ETFs following the NYSE higher. The only thing turning down, no surprise with rates ticking up, is the TLT bonds. Breadth, stocks above the 200, stocks above the 400 are at areas where reversals occur. They're not super extended, but they're close. If you look at the T2121, the 13-week or 3-month new high, new low, we are at an area where reversals occur. Doesn't mean it's tomorrow, but it's getting closer. The daily McClellan continues to show some divergences as we do on the weekly, and this is, to me, is what a melt-up looks like, because we've clearly changed the ascent on the weekly S&P 500. Now, what else do we have that shows we're overbought? If you take all the stocks in the S&P 1500 and look at where the price falls within their Bollinger Bands, 2/3 or almost 70% are above the midline. That's bullish. But 23% are actually above the upper band. When I see this, I realize that there's going to be pressure on those stocks to come back within the Bollinger Bands. Now, one thing I've learned over the last 20 years is overbought markets can get more overbought, and just because it's extended doesn't mean it happens on Tuesday, but it will happen. It probably happens sooner than later. There were no Hindenburg omens firing, so that's a good signal. Market tone remains predominantly bullish. I'm looking at the Woody indicator here. On sector strength, you could see the weakness in energy, and other than that, it's actually improved from last week. Now, canaries in the coal mine represent some of the big boys in the market, and you could see they had a huge move up here to new highs. Sort of after setting highs earlier in the week, went sideways. Here's a list. Yes, Priceline is now called Bookings. That is accounted for in the index, but someday I'll change the name. They're flagging after a big run-up. Perhaps they broke out of the flag and they're going higher. Know your news and earnings. This is especially important now. As I say in the lower right-hand corner, it is a judgment call to hold stocks over earnings date. It's bad judgment to not know when your stock's earnings date is scheduled. In my life, I've had great Netflix earnings days. I'll show you my SIGNET earnings surprise from this week. But I've also had things blow up. It's not a time to be heroes and take super large positions. And don't forget, as we go into earnings, volatility goes up, so the time premium, the extrinsic value gets higher and higher. The big thing for me as I look at this is, we are at the beginning of big time earnings. Halliburton on Tuesday, Schlumberger had some cutbacks and bad report last week, so we'll see what happens there. There's still some banks, especially the smaller banks. Netflix is the big fella after close on Tuesday. I've got 2 positions net long on Netflix. They are both designed that I could sell if I want to prior to the earnings announcement and take some advantage of the run-up in volatility. I'll probably hold at least one into it to take advantage of what historically is strong seasonality. Now, seasonality may be different now because of Disney, the Peacock, and others. My guess is it'll still do fine. Teradyne is on my leaders list, which we'll talk about in a few minutes. It's got earnings this week, as does ASML, another very strong stock. Some other airlines, more small banks, and financials with American Express. A very big week of earnings. Not such a big week on economic reports. You got some leading indicators and jobless on Thursday, home sales on Wednesday. Monday and Tuesday are very quiet. PMIs have been known to move the market if they miss. And as you could see, we got PMIs for both manufacturing and services on Friday. Got some extra things for you this week. Now, I've had an amazing return, and I'm sure you have too, over the first 2 weeks of the month. And I want to call out, just in case you're feeling invincible and feeling like you figured out this game, that you're up a lot because this market is on fire. Why is top-down important? Imagine you can take a handful of folks, the same folks every week over a year and a half, every month, each month picking a handful of stocks that they think will lead the market, and then someone keeping track and then independently monitoring the type of market, strong market, which is what we're in now, a weak market, which we were in December a year ago, and then a mixed strong, mixed weak, which is up or down, but not nearly as aggressive as those two extremes. And what this shows is a couple of things. First thing it shows, in a strong market, smart stock pickers can get gains of as much as 100% in 20 days. 20 days is about a month. Now, what you also see is those gains happen and then mitigate. So one reason to take things off early would be the fact that had you held these stocks for the first, after 20 days, your gains actually were reduced, both in a strong and a mixed strong market. In a weak market, even the same stock pickers that could get 106% in a strong market could not get positive returns. Not only could they not get positive returns, but in a weak market, your returns go from bad to worse. So don't hold on to things in a weak market thinking they're going to get better. So what are we in? Here we have some charts. These charts, and you can always freeze your computer and look at them. These are the S&P 500, the NASDAQ, the Dow, just like I have in my Thinkorswim charts, the Russell, and then I've got bonds here in the dollar. I don't have volatility. And what I'm looking at is returns by month going back 20 years. You can see that January, this tells me the monthly average return, and it's in that direction 61% of the time. So clearly for the S&P, January, February, March, and April and May are good. Then you get sell in May and go away, where July actually is very good, but June, August, and September are weak. And then we continue strong throughout the rest of the year. And it's going to be similar with some differences as you look across the other indexes. What I wanted to point out is we're halfway through the month, and trading days maybe a little bit more, and we're up 3% on the S&P, 4.6 on the NASDAQ, 2.8 on the Dow, 2.1 on the Russell, 1.9 on bonds, and 1.3 on the dollar. So if you're long anything, you're probably making money. These are very, very big numbers. Very big numbers. I can look at sectors, and I could see that the one sector down is energy. We got 2.6 up in healthcare, 1.3 in staples, 0.8 in financials, 3.6 on industrials, lost 0.5% on materials. I guess that's not a big surprise. 5.9% on technology, which is leading the market, and 3.3% on utilities. Interestingly, in a strong market, why did utilities break out last week? You can stop these, you can look at this, you can get a sense how this is compared to other months. Other thing that I did this week is I built my E-index for this year. Now, what is an E-index? This is something we learned from Ian 20 years ago. You're building an early warning sign as a market nears a top. You take market leaders, no more than 2 stocks per industry group. You're looking for tight stocks from lower left to upper right. The more extended, the better, because you're looking for leaders that are extended. Some key points. This is not, emphasize not, a buy list. Leaders will fall first, giving you a clue that the market will roll over. And if and when this list rolls over, we know the market is either rotating or about to fall. So here is my E-index for this market run-up. As you can see in the lower right-hand corner, whether I look at a daily chart or a weekly chart, we are in a straight line up over the last couple of weeks. This is clearly a chart that you would like to own in all your stocks, showing a massive move. Here is a list of the large number of lists, much more than normal, 46 stocks that I put into this list to give me a broad base. They all look good. Some look a little bit better. No more than 2 per industry group. You can see the heavy representation of technology, industrials, and healthcare, and then a few of the others. There's no real estate here, interestingly, nor is there any energy, which is not a surprise. I look at this daily. Why do I look at this daily? Because when this breaks down, it may give me a warning that the market is about to break down as well. Now, I put out something about making some money on Tesla. So sometimes it's better to be lucky than good, but use a few things to help you be better than just lucky. So we all know that Tesla is out of control. We know that Tesla has had a run from a surprise in earnings from 250 up to 550-ish, and it's done that in 3 months. We also know that there's no way that that's sustainable, and gee whiz, it's still a car company despite its multiples. Yeah, I had a Tesla. I love the car. I can see myself buying the fancy sports car when it comes out, but it's a car. So why did I short it? I shorted it because I knew it was stretched. So here's my high jump signal, and these yellow dots are all the days when the price closed above the high jump. The reason we call it the high jump is because that's typically a point where it's going to reverse. Similar to the low jump, gave us a reversal down here when it got to 170. It measures extension to the upside or downside. Now, this to me was a reversal pattern up here. And when it started to trade down and got below the low of this day, I decided it was time to short the stock. So rather than shorting it, I did my synthetic trade to the short side. So let's talk about what I did. What I did was I bought $535 puts. I sold against that 535 calls, creating a synthetic position where I'm short stock synthetically. And then I bought 545 calls to protect me in case the stock started to go up. Net, I spent $23,000 to control 2,500 shares. All right. By the end of the 23rd, the stock had closed down considerably, and I was in the money. Over hours, not on the 23rd, on Wednesday. After hours on Wednesday, it dropped further. As I was lying in my bed near market open, because I was in San Francisco, I saw two of my trades had returns of had gains that day of $70,000. One of them was Tesla. I immediately at the market open said that hogs get slaughtered, and then I saw a huge return. I was just going to take my money off the table. So I placed the trade on the 15th at a cost of $23,000. I closed the trade at 9:33 a.m. the next morning for a payment of $93,945. By my math, that's about $71,000. The net, $70,794, which is essentially a 300% trade in one day. I then took some of my money and I opened up a short butterfly, a butterfly of puts that for further action to the downside. I'll make sure I said it the right way. That was a pretty exciting trade. The other trade that woke me up on Thursday was SIGNET Jewelers. Now, I had some SIGNET over the summer or late summer and made some money over here. I was out of the trade, but I'm a sucker for earnings, and I see $3.47 coming in the next quarter. I also saw that it's highly under demand and pays a big dividend. So I decided on December 30th, when it had a PSAR reversal, and on TradeStation it had a new person indicator, it just had a mobile breakout, that I would take a position. This is a synthetic long. I bought long calls and sold puts at the 20 strike, and then I bought puts at the 19 strike. Now, why would I do that? It reduces my cost of this trade from 305 to 260. It's two trades that, if I'm correct, I can buy back this put spread for less money. So I paid for this put spread. I was paid 35 cents on the put spread, risking $1, and I basically bought it back for a nickel. All right. I closed that on Thursday the 16th, but left 25 calls in play and sold 75. Again, another $70,000 trade, and still got some calls in place, $20 calls. The point of this is that neither of these were super expensive trades. These were not expensive stocks. You don't have to have $1 million account to take these trades, and they both, in a very short time, created a substantial gain. I call those A trades, and when I do my live seminar coming up to be determined date, I will go through a series of stocks and show you how I traded them. Another great week in the market. January returns to date are spectacular. I'll show you spectacular right now. I started the year with about 1.7. I paid my taxes and still got over $2 million in it. And just to show you, on 1.7 starting, I'll use that number, my P&L to date is $571,000. That's the second January in a row I broke $500,000, and I haven't even gotten to the Netflix trade. On 1.7, that's about 30% return in 2 weeks of the year. Hence why I started taking stuff off and raising cash. You can see my cash position here is pretty high, $776,000 of buying power, because nobody gets those returns and they're sustainable. So far a great start to the year, hence the E-index and other things that I did. And I already mentioned some of the things I'm doing, but we'll talk more about it. So, fabulous start to the week. We continue to climb wall of worry, but they're falling aside. Impeachment trial on deck. I can't see the number of senators switching, and therefore this will be a trial and then an acquittal. The shift to the left in the Democratic Party probably gets even more aggravated and worse because of this. China phase 1 deal is done. Now on to phase 2. Let the rhetoric begin. Notice the comments were actually well accepted, that some of the tariffs are maintained, and to make sure that they push to phase 2. The North American trade deal will be signed this week, perhaps. I know it's been signed by both houses of Congress. Iran, who would have thought we'd take out a general. They'd hit back at 2 of our bases. Now it appears there were some injuries. And then we would stand down. Wow. And then Putin, this will be perhaps the next interesting thing. He fired his government, Medved, etc., so he could put his own stooges in and expand his powers. Big earnings on deck. Will they disappoint and give an excuse to rollover? Got my bet on that. Markets remain extended, yet extended markets go on for some time. I have taken profits. I've rolled remaining options up and out, bought some puts on extended stocks, and I'm ready to pounce long or short based upon signals after the holiday. Let me talk about up and out. Let's say you have Apple and you've got 270 calls. And now Apple is what, 311, 315. All right, that means that $270 call, and congratulations, you did well if you got that, is now worth $40 or $50. Apple is 318. So that 270 call is worth probably $55. Why would you have a call that's going to expire that will be short-term gains no matter what you do and leave that much money that can go whoof if the market corrects? Rolling up means I'd roll that 270 call to maybe a 310 call. I would move the month out 1 or 2 so that I have more duration in case there's a sell-off here. And then I might sell a call out of the money to pay for that transaction, so you get most of that roll up out in cash. Well, I did that across my portfolio, and I do that each time when the market looks like it's going to correct. The worst I ever felt would be if I had $100 in a call, and then there was a bad earnings, that $100 call became worth $10. And that's happened to me in the past. I've learned trading up and out is a great way to protect your nest egg. Cash is king too. I have no fault if you took cash on that Apple trade as well. So we've spent a lot of time on the background. It's hard for me to tell you to go in all long here, but there were some good stocks. Let's take a look at them. So let me close out my TC2000 picture. But let me just give you a little clue about what's going on in this market. Spiders, high jump. Diamonds, whoops, high jump. Qs, high jump. IWN, high jump. IWB, high jump. Where are we going to hide here? I mean, the dollar's always good. It's in the middle of its range. Bonds are in the middle of the range. When I see all these indexes at their high jump, I get nervous, and I think we're in that scenario now. So let's take a quick look at my TradeStation tool, which I use to get a sense of the market, which you can already tell what my sense is. And so what's new here today is, I don't want the third column, I don't want to have. There we go. Is I brought my high jump tool into the radar screen. And I have both a daily and a weekly high jump here. So first thing I like to do is let's just look at that and get a sense of what's going on. Let me just stretch this out. There we go. You could see high jump bar on the Russell's 95, on the mid caps it's 96, it's 100 on the E-minis, NASDAQs, and YMs. What does that mean? Let's look at the E-minis. So the E-minis, I look at about 6 points. Are we in a buy signal? Absolutely, for quite some time. Daily, weekly, monthly. I look at the price bars, actually green on the daily, blue. Green and green. That's great. I look at where we are in the outer envelope. Boy, are we extended. but we can be extended for quite some time. 4, I look for these little red dots. That tells me we have some MACD divergence. Notice that the MACD histogram cannot get higher than the prior hump despite higher highs. The weekly bongo, all daily, weekly, monthly bongos are green, but this high jump bar, which is a measurement of extension, tells me we are as extended as we've been over the last year. Typically when that happens, the market pulls back. So that's the E-minis. The Dow futures look exactly the same. The NASDAQ futures look, you ready for it? Exactly the same at 100%. The Russell futures, not quite as extended, but 95% is still pretty darn extended, and they actually came back in a little bit this week. And then the Dow futures, we've already looked at those, my bad. All right, so clearly extended. If I look at the dollar, it's going to be in the middle of its range with a new buy signal. A buy signal on dollars on daily and weekly, what does that tell you about gold and silver? It tells you that they might be under some pressure. So, certainly an extended market. Extended markets can go on further, but I think I think it's inevitable that we see some element of a pullback. Again, I'm expecting a modest single-digit correction if and when it occurs, and not a bear market. Therefore, I still have some long positions because unless you're better at predicting than I am, I take it a day at a time and I adjust my holdings based upon what the market gives us. If I jump into HGSI and I want to look at market analysis groups, let's look at the Major Markets Plus, hit the warehouse view, bring this up to resize this. Let's go to top-down view. So this was a way I rank stocks or indexes on price and volume, heavily weighting the last couple of days. And, I never like to see utilities leading. I mentioned before, having utilities breaking out and leading cannot be good for the overall market. Yet, small caps and NASDAQ are up there as well. I just get the sense that we're starting to top, continuing to top. Not to say we can't run up a little further and enjoy a little bit more of a melt up before that top actually comes. So let me go into my index view here. You do not have all these views. You will have an opportunity in the next couple of weeks. We will announce the John Person add-on. It will come with all the views that I use and everything that you see on my screen from HGSI. I'm very much looking forward to bring that to the market, as well as some closed door education. Not going to spend much time here. It doesn't matter if I look which I look at. All-time highs on the S&P. All-time highs on the Dow Jones Industrial. Looks the same, doesn't it? NASDAQ Composite. All look the same. What doesn't look the same necessarily are the Russell. And what you can see on the Russell is it gave back a little bit with a red candle high at the high jump. That's a bearish configuration. It's worth keeping an eye out. The weekly doesn't look so bearish at all. If we look at the 50, which are the actively managed fund of IBD 50s, the ETF, and you can see it is near the top of its range. Hasn't set an all-time high. It looks a lot like the Russell on that. Very quickly, semiconductors leading this market. Look how strong they are. And that's your index right there of leading stocks. But I don't put the index in my E-index. And if I look at biotech, last week was the JP Morgan conference, and wasn't nearly as strong an M&A vehicle as it was last year when Bristol Myers Squibb announced a acquisition of Celgene. That was pretty exciting there. Did get to see a lot of very smart people presenting and hear about a lot of exciting companies, both private and public. If I go down and I look at the dollar, we already know that it strengthened on my TradeStation picture, and you can see the dollar had a big move up. It's off of its bottom on daily and weekly. The VIX, we talked about being down in complacency land. Well, there's another name for that. That's kind of where reversals start to occur. We're complacent. We're about as low as we've been in 2019. If you're at the lowest you were, what's the only way you usually go is up. And if the VIX goes up, you'll sense it in your portfolio with some market rollover. So that's something to at least be aware of. Gold with $1 strong, you'd expect gold to moderate. Really didn't sell off much. And near its highs, obviously a lot of people have been looking at gold and silver as ways to play the upcoming market pullback. Problem is, I don't know when that's coming, neither do you. Silver looks about the same as gold. So now that I've done that, I go to 07 industry groups at the warehouse view, and I have 175 groups. Of those, I've got 59 to the upside, and I have only 19 to the downside. If I look at a 5-day, a little bit longer window, I only have 15 to the downside, and I have 68 to the upside. That's what a strong market looks like. It's not crazy with nothing to the downside, but over the last couple of weeks, we've clearly reversed to the upside. That means it's a lot harder to find basing stocks that haven't broke out yet, especially fundamentally good ones. So what I like to do is I like to look at the first couple of groups, and this is what a top-down is. We started with the indexes. Now I'm going to right-click, left-click on semiconductors, right-click, and then left-click change index group, and now I can go down and I can look at these. Qualcomm, this has been one we've talked about a lot. It broke out on Friday, took out its recent high, 2 kahunas in a row, very bullish pattern. My only concern with Qualcomm is it's run a long way, yet it's so close to the indexes it's not extended. Qualcomm looks interesting. I am in AMD. This one is a lot more extended. My God, this is what you want. You see the little green arrow there? That's the John Person arrow. If you don't see it, you see that line there. Kahuna, person buy, in a squeeze, pulling back to the major moving averages and a spring higher. I'm still in AMD, although I have protected my position. What does that mean? It means I sold a call at 55 and I bought it put at 50, so that I've sort of collared my risk and my benefit. Lattice Semiconductor, sideways move, broke out this week. That looks interesting. Relatively inexpensive compared to some of the other semis. Marvell, Texas Instruments, anything here I want to look at. NVIDIA, what a great run this is. I had so many choices to put into my leadership category. NVIDIA didn't get it because of the stuff back there, but I certainly could have put it there. Infi made the list. This is relatively tight, lower left, upper right-hand corner. Would I buy these now? No, they're extended. They've run. NXP Semiconductors was a consideration as well. It has run as well. Hard to buy these things, in my opinion, when they get to be this extended. So you have to be careful, especially when you see a red candle high occurring in the setting of an extended stock. All right, that was semiconductors, plenty of there to like. Specialty pharma. Don't know anything about Northwest Inc. This is the pattern of be careful. So you've got a stock that back here was trading 50, 100,000 shares a day. Then all of a sudden some news comes out and it now trades 500,000 there, 7 million there. These don't usually end well. You play these at your own risk. They're a lot of fun on the way up, but when they come down, they hurt. It's NatWest, not Northwest. The reason this one ran up, this is owned by a guy named Patrick Shunshung, is the founder. He used to have a company called Abraxas that he sold to Celgene. He said he cured a patient with pancreas cancer with his vaccine. A lot of skepticism, but it's an exciting story if it's real. 47, another biotech ran up, pulled back. Now it's running. They got some really exciting drugs early on, a couple kahunas. I'm actually going to look at this one. I think this one can go a lot further. It's got some real drugs. It's further in their development. Mallinckrodt. Oh, man, I'm just dying to know how much they paid. They bought a company called Questcor. this is a company that I thought was always flawed. They paid how much? $5.6 billion buyout of Questcor. Questcor has a drug called Acthar gel whose price went up faster than, let's put it this way. What was that guy's name? The pharma bro that went to prison for egregious price increases? Questcor did the same thing. Malincroft bought them for $5.6 billion. Now watch what its market cap is. $437 million. So this company has been destroyed by that acquisition. I've heard some good things coming out of there. It's starting to move a little bit. It trades at a multiple that's less than 1x earnings. It has a huge demand. This might be something you buy and you put it away because there's got to be some assets there that have value besides their Acthar gel. Canopy Growth, the marijuana stocks popped early in the week, then pulled back. Maybe it's time to get back in them. It certainly looks more impressive on the weekly. Kronos is another one of those. Clearly, they're under demand. Anything else I want to show you here? I do like this one. Zota ZTS is another lower left, upper right that made it to the index of looking for rollover. Okay. Biotech, no surprise with JP Morgan week. So speaking of which, this was a stock that ran from $8. On this date, its high was $152. And then it came down to base at $72. And now it seems to be running. I'm interested in it now. But boy, it's hard for me to chase things in this period of time. So often I see this pattern, and I have a whole set of this in one of my presentations. They always end up the same way, and it's not pretty. Novavax, you want to take another flyer. This is a flu vaccine company. We got a bad flu season already breaking out. This could be a banner year for flu. 3 kahunas in a row. It looks interesting. You can see the group is strong. A Bible gap up, following a mobile breakout from a squeeze. Take a flyer. If it runs up to $8 to $10, you made a bit of money. It's like buying an option that doesn't expire. Clovis is a target of M&A. Biohaven, it's interesting. Sideways move. It had a kahuna, a pocket pivot, a mobile breakout from a squeeze. Really going sideways, so I probably wouldn't be that excited by it. So another group that looks interesting. Communications equipment. So again, I highlight it, I right click it, and then I use my left clicker to change the index group. I double click, and that's going to bring that down here. Apple, looks to me like it's getting a melt up. I own Apple. I have had calls that I've ran all the way up. So just to give you an idea, I had those $270 calls. I still want to be in the stock. So what I did is I rolled those calls up to, hold on, I'm looking right now. I have 290 calls now that expire in March. And I actually have a $315 put that I put on last week as to protect my position. So I actually started in the 100s on those calls and rolled them up and out over the last year. So I'm excited for Apple, but would it surprise me if it pulls back into the 305, 310 range and goes sideways? No, I'm expecting it. Nothing goes like this forever. Cisco, no. Motorola Solutions, I just wish it had a different name because I think of old stodgy things. Had a great run up, pull back, mobile breakout from a squeeze, a kahuna. This is definitely where I like to buy something. It's already had a run, but it's something that's on my watch list. I wish I would have bought it back there when I first talked about it. So I go through the list looking for stocks that are decent setups. When I get to the index, I move on. That was communication equipment. Renewable energy, can you say? We got Enphase in a second. Ballard Power, boy, hard to chase this. It's still a relatively cheap stock. 2 million shares a day, big move up. Pull back to the 50, person buy signal, kahuna, and a mobile breakout from a squeeze. Look back here. I buy the same way every time. This is extended. I can't buy that. End phase has been a big leader. Sun run. It's at an interesting buy spot. Don't know much about it. It's got some pretty impressive earnings coming in. End phase has been a leader here. Pull back and had a big move. The other one of interest is Solar Edge. Similar pattern but broke out. Sideways move. Of course, I owned it here and sold it. Great earnings per share growth. I like Solar Edge in this group if I was to go back in. Not nearly as extended as some of the other stocks that we saw. Consumer finance. I bought Visa coming off this space. And Visa's just on a great run. Long Visa. I wish I was long MasterCard as well. Would I buy it here? No, it's too far extended. Look, here's the high jump bar. I'd roll it up and out, which I did. MasterCard. There's global payments. This is a double from the beginning of the year, and this one is on our leaders list, as is Visa. These look great, but they're all extended. I'm looking for things I can buy today. Maybe I could buy Capital One, give me a little bit of a flag and a breakout, mobile breakout squeeze. Pocket pivots, kahunas. This is a bar of the buy signal and positive over here. That looks interesting and a possibility, but it's kind of extended as well. Fiserv, every time this thing goes sideways, I talk about buying it and it pops up again. Looks like it's running, but it too is getting expensive. Anything else that popped up here on my list today? Nope. All right. So I usually go down through 10. Internet media. Got sometimes, is this the one that's got that AYX? No. I'll bring it up if I have to. Google got some upgrades. One of these is on my leader list. It's run from 1,000 up to 1,400 plus. Great move. Extended. Hard to buy it here. The point is that leader lists are not buys. They're stocks that are extended. Google. Snap. You could have bought it down here. I'm not a fan of Snapchat, so I didn't buy it. Wish I did, breaking out to new highs. Facebook, I have a long position here. I've had it since about 60, and I maintain it. It's funny, it's one that I sold puts on, and then the stock got put to me, and I just kept it, which turned out to be a good thing. Nothing to do there if you own it, except enjoy the roller coaster. About 2 weeks ago, I saw this thing pop up. AYX. I took the stock right here. And I think I talked about it. This little AYX thing, I'm still in it, although I've rolled it up and out. I didn't think much of when I bought it. I bought it with a, kind of like I bought the SIGNET, had a $35,000 hit. The stock has moved, but it didn't move that much. It was just the way I designed my option strategy, which is why I like options so much. Infrastructure software, Microsoft. This is another one I own. Would I buy it here? No. Look at this. Run up, sideways move, mobile breakout from a squeeze, then kahunas, pocket pivots, a new buy signal, 145 to 170. That's what I'm talking about. That's when I want to buy it. Hold on, I want to see when I bought my Microsoft. I'll be back. And I already turned that off. I'm not going to go look. But that would have been my trigger to buy it. I think I bought it back there. CrowdStrike, we talked about this a couple of weeks ago. Another one of my synthetic 37,000 gain year to date on CrowdStrike. Okay with that one. Again, stock didn't move that much. It was the position that I took. ServiceNow, too far extended. Progress had great earnings, and you can see what happened. Gapped up, still closed up on the day quite a bit, but it gave back some of this gain throughout the day. I'm also long CyberArk, which has been sort of a slow meanderer. Probably too heavy in that group. Application software. Intuit, it's viable here. It's coming out of a fry pan bottom. If you're into that stock, I'm not into it. Not my stock. Adobe, this is my stock right here. Was the time to buy it? Too far run, like everything else. Nice to have. Don't go buying it now. Activision Blizzard, a lot slower move up. Probably could be purchased here. If I had to buy gaming, I'd probably buy Take-Two, which is coming. Run up, cup, handle. All I need is a breakout here. Something going on with the gaming stocks. They look interesting. Now, were there any other stocks here that I liked? This thing made my leaders list. No, it did not make my leaders list. Wrong one. Never mind. Not SAP. I was tempted to put this on my buy watch. Mobile breakout from a squeeze, a new person indicator. My only, not as extended. It's had a big run. I own some of this. I decided not to put it to my buy list. Viva. Boy, someday this stock will break out. Right now, it's just going nowhere. I had some of that, gave it up, which means it'll pop on Monday. And Paycom, speaking of giving it up too early, I own this early on. What a great leader. Didn't put on my E-index because of this mess, but what a beautiful lower left, upper right. Would I buy it here? No. That was the story of my review this week. A lot of great things, but would I buy them here? No. They're too far extended. And lastly, generic pharmas. Don't know what happened with Momenta, so let me just show you one of the tricks at HGSI. Big move up. On big volume, 5 times normal volume. Bible gap up, so right click, more info from web, left click on FinViz, and it'll go right to Momenta Pharma and tell me new treatments, board changes, positive analyst thing. Okay. Probably had something to do with JP Morgan presentation. So, Empirigo, not that exciting. So, there were quite a few things here despite a market that's extended. I did my usual review. Let me show you what I found on my sort of ridiculously massive bottoms up chart pool. Looked at 700 charts, and these are some of the things I came up with. Those who've never been here before and go, how am I going to follow those? I'll say simple. I'm going to stick them into TradeStation, which I've already done. And I'm going to go into what will be running on my big monitors during the day. And I have my current holdings, my buy watch, and my short watch. And I'll be looking for signals to occur during the day. And in case you can't see, I've got the wonderful Q signals from Cigar. I've got some of my HGSI related signals, and I got John Person stuff. And most importantly, I've got this thing here that tells me when my earnings dates are. So I know this week I got to worry about Netflix and maybe Key Bank on my current holdings. I have a couple on my buy list. What do I do around earnings? Well, let's play Netflix for a second if you'll bear with me. Around earnings, I'm going to go into one of my